Thank you, friends, for tuning in once again. I'm your host, your lecturer, Spotter Fred. I'm happy to host you once again. Now, today's lesson or session will be continuing with our earlier topics. Remember, we are doing topic 3 in advanced financial reporting. We are still doing advanced financial reporting, and we are in topic 3. In topic 3 is about assets and liabilities. In assets and liabilities, we had assets held for sale, that is IFRS 5. We had impairment of assets, that is IS 36. We had exploration and evaluation of mineral resources, that was IFRS 6. D, we have financial instruments. That was IS 32, IS 39, IFRS 7, and IFRS 9. Then we have share-based payments. IFRS 2. We have taxes. IS 12. We have employment benefits. IS 19. So far, friends, from our previous sessions, we have already covered this. We have covered IS 36. We have covered IFRS 6 in our previous sessions. We have also covered financial instruments in our previous sessions. So we have not covered the share-based payments. We also not covered the taxes. We are also going to cover the employment benefits. So far for today, we want to look at share-based payments. That's the area we want to look at now, share-based payments. Share-based payments. IFRS 2. Share-based payments, IFRS 2. According to share-based payments, in IFRS 2, the concept is simple. We want to value the services and the goods we are selling. We want to value them in terms of shares. We want to recognize the shares or the value of the shares that will be issued in exchange for the goods and services. So how will they be recognized? That's our concern. Where we issue shares or where we exchange shares for goods and services, or we calculate our payments based on the number of shares and a certain price. How will they be recognized? How will they be measured in the books? So we come to share-based payments, and IFRS 2 has given that recognition. Now, the main objective of IFRS 2 is to be concerned with 3 types of share-based payments. Yeah, objective, concerned with the 3 types of share-based payments. of share-based payments. That is, we have the types here. One, we have the equity settled. Two, we have the cash settled. Three, we have choice of equity or cash settled. Those are the main three types of share-based payments. Now, friends, when you talk of equity settled share-based payments, is where we are going to issue shares to the holders. We are going to issue shares to those who have provided services or to those who have supplied goods to the farm. So we issue shares to them which they can exercise at their time of need. Then we have the cash settled. When it comes to the cash settled, friends, we'll be looking at the number of shares. We'll be bargaining, we'll be making some payments based on a certain number of shares at a certain price of that share. So get the difference. When you talk of equity settled, we are looking at the number of shares that will be issued to those who have supplied goods and services to the farm. When you talk of the cash settled, we'll be looking at how much do we pay based on the certain number of shares at a certain market price at some point in time in future. That's the main difference. Equity settled, we issue shares to the providers of services and goods. While the cash settled, we give them cash, but that cash will be based on a certain number of shares which may be issued at market price. So that's the main difference when we talk of equity settled and cash settled. Another issue or another big difference is on recognition. How do we measure recognition and measurement? How do we measure this? Remember, when it comes to equity settled, we are going to recognize them using the fair value at the grant date or the agreed price at the grant date. The grant date is the date we have agreed between the service or the providers of goods and services and the entity. The date they have agreed on a share-based payment. The date the share-based payment agreement was reached upon. So we'll have equity settled that will only be valued or measured based on the fair value at the grant date. And it will not be adjusted. The pricing will not be adjusted. On the other side, when we look at the cash-based payments, we'll be revaluing it. We'll always be remeasuring it. We are going to use the fair value at that point in time, the fair value. We're going to measure the shares. We're going to value the goods and services using the shares, the market price of the shares at that point, at one point in time. So this means that every year we are going to do remeasurement. We are going to make the necessary adjustment. If the price will increase or reduce, we'll be use the new price every year. Those are very important differences that we need to note. Remember, the equity settled is where we are going to issue shares to the providers of goods and services. The cash settled, we are going to pay cash, but the cash will be based on a number of shares at a certain market price. Second difference is where we are in equity-based payment, we are going to measure it using the fair value at the grant date without changes. While the cash settled, we are going to use the market price or the fair value at each reporting period that may be changing over time. So if this year it was 50 shillings, the next year it will be 55 shillings, and thereafter it will be 70 shillings. We'll be using those prices. That's for the cash-based payment. But for equity-settled payments or equity-settled share-based payments, we are not going to make an adjustment. We are not going to remeasure. We simply use the fair value, the fair price at the date, at the grant date, and that's all. That's important. So it's interesting. This is one of the shortest standard, right? One of the shortest standard. Remember, if you are able to remember the three types where we have equity settled, we have the cash settled, and a choice of equity or cash settled, it will be very, very important. Now, then you also need to remember, as we have just said, that equity settled share-based payment transaction in which the entity receives goods and services in exchange for equity instruments of the entity, or that is shares. While cash settled share-based payment transaction in which the entity receives goods or services in exchange of amounts of cash that are based on price of the entity's shares or other equity instruments. And then there is also a choice between equity and cash settled. Now, there are some arguments which have been against the share-based payments. One of the arguments is that no cost, therefore no charge. We should not charge anything because we have not incurred anything. Yeah. Another one is that earnings per share is normally determined twice. If you're going to account for the share-based payment, and there is also a share-based payment as share options, then we are going to determine the earnings per share. We are going to, duplicate the determination of earnings per share. Then we also have adverse economic consequence, which may be as a result of share-based payment. Fine. Remember, we have some terms like grant date, we have already said. Items like grant date. What is the grant date? Is the date when the share-based agreement was arrived at. 2, we also have the vesting status. Vesting status is a status upon which an employee or an individual will receive, especially an employee, will receive some additional benefits even if he has not rendered any additional service to the firm. We have also vesting conditions. These are conditions that must have been achieved for this employee to have the vesting status. So those are some of the items. We also have the vesting period. Vesting period, friends, is the period during which the vesting conditions must be fulfilled for the employee to benefit from the vesting status. Fine. Now, after that, we are also going to look at an example. We are going to look at an illustration. And this will be an illustration which will definitely be an equity settled share-based payment transaction. So we can read this example. We have our example. On 1st January 2017, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 2019. The fair value of each share options is 20 shillings. During 2017, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. During 2018, a further 25 employees leave, and the entity now estimates that 25% of its employees will leave during the 3-year period. During 2019, a further 10 employees leave. Required, calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2019. Fine. Now you have noticed in that example, there are 3 years. Yeah, 3 years. There are 3 years. That's the vesting condition, the vesting period, can say vesting period. Then another item we have been given from that example is that there are how many employees? Yeah, 400 employees. How many options? We have 100 options granted. From that example, friends, we have been told that the fair value of each share option is 20 shillings at the granted. So the fair value at the grant date is shillings 20 per option. Those are share options. Then we have also been told that there are some employees who are expected to leave, that employees record. Employees record. In 2017, 20 employees left. 20 employees leave. That's 20%. In 2018, 25 employees leave, expected to leave. That's 25%. Then we also have in final year 2019, 10 employees to leave. Thus, we have not been told the percentage, but that's the final. That's the final that we are going to deal with. That is very okay. If they are not given us the percentage that is expected, we could have used the 20 and 25. We could have used the number, the actual number of employees. Fine, no problem. Now, what is the required? The required, we calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended, that 1st December 2019. Fine. So what do we do here? We come and say, we want to have just a schedule here. We'll have the year. This is 2017, 2018, 2019. This is now amount to be reported. Amount to be reported. Amount to be reported to the statement of financial position as equity. Then amount to be reported. Amount to be reported to profit or loss as expense, as remuneration expense. What are we going to recognize as remuneration expense? So the computation will be, we have 400 employees. They are granted 100 options each. But remember, at what price? 20. But there are also those who are expected to leave. So we are expecting to have 80% remaining. But remember, this is also the first year. So how much would that be? Because of space, let me have it here. Then because of space, let me also try to create some more space here. Then the second year, we have the 400 by 100 options by 20 shillings. How many are expected to leave? So we are expected to leave 25%, so we are remaining 75%. Then times 2/3. The final year now, we deal with the final, with the exact data. We know that we have 400, right? And these 400, we're expecting that there are those who have left in the first, 20 must have left, 25 must have left in the second year, 10 must have left. So the total comes to, that is 20, 45, 55. So we subtract 55. We multiply by 100. We multiply by 20. Then now 3/3. So how much will that be? So I take my calculator, I come and say 400 by 100 by 20 by point, yeah, then that is coming to 213, 333. Fine, no problem. Then we also have 400 by 100 by 20 by 75 by 2/3. We have 400. That is okay. So this will be reported to the statement of financial position. Then we have the 400 minus 55 by 100 by 20 by 2/3. Yeah, by, sorry, 400 by minus 55 by 100 by 20. So we have 690. So what would be the amount to be, this is what is going to be reported to the statement of financial position. How much do we report in our statement of profit or loss as an expense? The first year will be 213, 333. Remember, this is only what is reported in our statement of profit or loss is expense for that only 1 year. But in the statement of financial position, this is the cumulative. But being the first year, 213, 333 was for that 1 year. So what will be for the second year? You can take the 400, you subtract the 213. How much would that be? So 400 minus the 213, 33. So we have 186, 667. How much are we going to report in the third year? I'll take 690, I subtract the rest. No, 690, I can subtract 400 so that I get 290,000. So if I add these items, if I add this, it should bring to me the 690. All those three should give me the 690. So that's what we should recognize in our statement, of profit or loss, and in our statement of financial position. Something to remind you about, if for example it was a cash-based payment, then we could not have used the constant 20. We could not have used the constant 20. We could have changed depending with the market price for that year. We could have made adjustment depending with the market price per share for that particular period. So that's exactly what we should do when it comes to share-based payment. Now, other examples, something else that could easily come in here again is if when they exercise of the options, what will happen? We should debit the bank account, cash proceeds, with the cash proceeds, which we don't have in this case. Then we credit our share capital with the par value, That's what we could have done. Then we credit our share premium. With the premium. That is at the date if they were to be exercised. Then we could have taken into account the cash process could be based on the final number of employees. And the final number of employees is 400 minus 55. That's 435. So that could be the final number of employees. We could have used that 445 to determine our cash process. So friends, this comes to the end of this topic, comes to the end of IFRS 2. However, we can guarantee you that we have the details. We have the details in our study text. But this is also very important as far as our exams are concerned in knowing how to account for share-based payments. I wish you all the best for the subsequent lessons, because in our subsequent lesson, we'll want to look at how to account for taxes and also employment benefits. Thank you very much. Have a nice time. Was your host, Mr. Spotter Fred, and see you next time. Don't forget to tune in.